So in this video today, I'm going to be answering one of the most common questions that I get every single day, either here on my YouTube channel or over on my investing blog. And that is the question of, how do these free trading apps out there actually make any money? And the thought process behind this makes a lot of sense because a lot of us were taught, especially when we were younger, that there is no such thing as a free lunch out there. I'm sure we've all been at the mall before or somewhere in public and someone comes up to us and says, hey, I want to give you a free cruise or a free vacation, and you get roped into this long conversation only to find out that it in fact is not free and you just surrendered over all of your information. So are these trading apps legit? Are they a complete scam? That's what we're going to answer today in this video. So unless you've been living under a rock, or maybe you just don't know anything about the stock market, you've probably seen these ads for different commission-free trading apps out there. Three of the most popular ones being Robinhood, M1 Finance, and most recently an app known as Webull. So these companies are spending millions of dollars on advertisements and acquisitions of customers, but they're not charging anything for trades, and most of them have a $0 minimum account balance. And not only that, but a number of these different apps are offering you free stocks just for signing up. And that right there is the perfect segue into a shameless affiliate plug for Webull. So I, of course, am affiliated with Webull, and they are offering users up to 2 free stocks just for opening up an account with them. So number one, you do have to open an account to get a free stock. And then number two, after you fund that account with $100 or more, you're going to get a second free stock. So if you're looking to get into investing in the stock market and you want to explore the Webull platform, they're going to offer you up to 2 free stocks just for signing up. That's going to be the top link in the description below. Now you do have to use my link in order to get those 2 free stocks, or someone else's affiliate link if you just don't like me. But if you download the Webull app from the App Store, you will not get any of the free stocks. I'm not just saying that, that is the God's honest truth. They are using this as a way to draw new accounts, and if you've already heard of Webull and you're downloading them from the App Store, they don't have to spend that money giving you those free stocks. So if you want to take advantage of that offer, that is the top link in the description below. So maybe you're one of these people that is still very skeptical about this, your inner scam alert is being triggered, and you basically want to understand how a company that charges $0 for trades has, in most cases, $0 minimum account balance, and they're literally handing you up to 2 free stocks. How is there any money to be made in this business? And just to circle back here and give myself a bit of a credibility point here, I have been writing about these different brokerage accounts and investing apps over on my personal finance blog, investingsimple.blog, for the last year. So I have put hundreds of hours into research on these specific platforms. And for this video alone, many hours of research went into this. All that I ask in return is that you go ahead and hit that like button for me. Don't worry, I will wait. Okay, thanks for hitting that like button, guys. I really appreciate that. It helps out with the algorithm and just overall shows your support for my channel. So I do appreciate that. But that being said, let's get into it and talk about how these brokerages made money in the past. So if we went back in time about 10 years ago or so, your only options when it came down to trading stocks were basically one of 2 options. Number one, you could go through an online discount broker. We're all familiar with these. There is Charles Schwab, there used to be Scottrade, TD Ameritrade, E-Trade. This is what you call an online discount broker, and these online discount brokers allowed you to place trades online, paying a small commission of around $5 to $10 per trade. Option number 2 was a little bit more expensive, and that was to go through an in-person stockbroker, and that was somebody you would literally call up on the phone and say, hey, I'd like to place a buy order or a sell order of these specific shares. So in the past, that was the only way that you could trade stocks. You had to pay commissions on your trades, and most of these accounts for these online discount brokers had minimum balances of $500 or more. And this made it extremely difficult for beginners to get started with investing in the stock market, because even if you had enough for the minimum account balance, you're spending so much money on trading commissions that even if you turned a small profit, your commissions are going to wipe that out entirely. So then in April of 2013, everything about the brokerage industry changed forever with the introduction of Robinhood. And Robinhood came on the scene offering $0 commissions, $0 minimum account balance, and they even had a referral program where if your friend referred you to Robinhood, you would both get a free stock just for signing up for an account with them. So this was extremely disruptive to this brokerage industry where pretty much the old way of doing business was what everyone was doing, and Robinhood came on the scene and said, nah, we're going to do it differently. So obviously a number of companies have now followed suit. M1 Finance originally charged fees to customers, but they went commission free over a year ago now. And then most recently we have Webull, which is a more sophisticated trading platform than Robinhood, which is offering commission-free short selling, commission-free trading, and all kinds of additional bells and whistles above and beyond what you see with Robinhood. So essentially we can credit Robinhood for starting up this new industry here of commission-free brokerages or commission-free trading. And this literally did not exist even just 5 or 6 years ago. But obviously, M1 Finance, Webull, and Robinhood are not charities. They have operating costs, they have employees, and they have to have a means to make money. And so they are in fact making money, but they made the decision to do it in a different way than the old school players were doing. So in the past, this is how you would make money as a brokerage. Number one, you would charge commission for trades. As we said, that's what these online discount brokers were doing for years. Or number two, if you built portfolios for your customers, you would charge an annual asset management fee. So for example, a common management fee was around 0.5% to 1%. So if you had $100,000 in a portfolio, that would be $500 to $1,000 per year in fees paid to that financial institution. Now, these free investing platforms obviously disrupted this business model and eliminated the commission environment, and M1 Finance even offers pre-built expert portfolios with 0% annual management fee. Now, it's important to understand that in order for these companies to offer all of these free perks, they had to do a significant amount of cost cutting, and there were some major inefficiencies with how these traditional brokerages were operating their businesses, primarily in 3 different areas. Number one was customer service. Phone support is extremely expensive and time-consuming, so all of these free investing platforms out there exclusively handle customer support through either email or chat support. You're not going to find any phone support with these free investing apps because they just can't afford it. Number two, the second area is paper. Paper is extremely expensive. It costs money to mail out statements. So all tax documents and statements are going to be sent electronically to your email or available through the apps. And then third and finally, retail locations. You can drive to a Charles Schwab or an E-Trade office and make a deposit, and you can call someone up on the phone, but all of that is going to be costing you money when it comes down to asset management fees as well as commissions. So there is no such thing as a Robinhood office or a Robinhood branch you can stop into, and these are the 3 areas that these free investing platforms have really cut back on in order to offer the perks that they are offering you now. So that being said, now that we're all caught up here, understanding the landscape of these free investing platforms, let's talk about how they're actually making money. But before we do that, I want to go ahead and do a quick survey for you guys. So what I want you to do is scroll down to the comment section below and drop me a comment of what brokerage you are currently using. I'm curious if a lot of people have switched over to these new investing platforms, or are they still going the route of the online discount broker or the in-person broker. So pause the video now. I will wait for you. Drop a comment down below. Okay, so the first way that these apps are able to make money is through the uninvested cash held within your brokerage account. So when you invest money through these platforms, you deposit money from your bank account into your brokerage account, and you use that money to buy stocks or bonds or whatever it is that you wish to buy. Now, not everybody invests all of their cash at once, which means that there is idle cash held within your account. Now, this may be as small as $5 to $10, but when you consider the fact that there are millions of different accounts with each of these platforms, that small amount of uninvested cash starts to add up. and they do not pay any interest on that cash, and as a result, they are able to loan that money out and collect interest on it in the process. Now, before that is a red flag for you guys, I just want to let you know that you are insured through SIPC, which protects you up to $250,000 for the cash held within a brokerage account. So if they loaned out all of this cash and lost that money, you are insured up to $250,000. And it's also important to note that pretty much every financial institution out there is doing exactly this. When you put your money in the bank, it doesn't stay in your bank account. It gets loaned out, and it's a means for that bank to make money. Your brokerage accounts are doing the exact same thing. All right, so the second way these companies are able to make money is through something called a margin account. And a margin account is where they are matching your buying power, in most cases dollar for dollar, and essentially giving you a loan to invest with. So for example, if you had $50,000 in your brokerage account and you opened a margin account, you would effectively have $100,000 worth of buying power. $50,000 is your cash, the other $50,000 is a loan given to you by your brokerage account. And just like a traditional loan from the bank, you have to pay interest on that loan every single month. And this is a way for your brokerage account to make money and earn interest, and it's another form of income for them. Now, this is an extremely risky area for investors. I don't recommend margin trading. I don't really know anybody who does, but it is a way that they make money. One example is Robinhood Gold. That is a subscription that allows you to have margin and gives you additional buying power for a certain dollar amount each month. And it's important to understand as well that through a margin account, your stocks are actually serving as collateral. So if you end up losing money on a bad investment, you will get what is called a margin call, which is when you are required to deposit additional cash into that account, or they will be selling your stocks and keeping that money. So it's a low-risk way for these brokerage accounts to make money by offering you a loan to purchase stocks. And if you do, in fact, make a bad investment, they have the right to sell your stocks and keep that money. Now, the third way that these brokerages are making money is by offering some type of paid subscription or paid membership. Robinhood Gold is an example of this where you're getting access to margin. Another example of this is Webull sells subscriptions to global real-time market data. So if you wanted to get real-time market data on different global exchanges, you can pay a monthly subscription to get access to that data. But it's important to remember that all investors are going to get access to real-time US market data completely free. If you have the desire to get data on other global markets, you can pay a monthly fee for that. And then lastly, M1 Finance does offer M1 Plus, which is a debit and checking account that offers similar cashback benefits to a credit card, but you do have to pay an annual fee. So that is an additional revenue stream for these free investing apps. Number 4, the fourth way that these companies make money is by lending shares out to short sellers. Now, this gets a little bit deep in the weeds here, but I'm going to try to explain this as simply as possible. Short selling is essentially betting against a particular stock. So most people in the stock market make money when the stock goes up in value. So you want to buy at $10 and maybe sell at $15, making money by buying low and selling high. Now, short sellers, on the other hand, are making money in the exact opposite way. They're betting against a stock, and they want a stock to go from $15 down to $10. That is when they would make money. So in order to do that, this takes place in a margin account. What they have to do is borrow shares from a brokerage account, sell them on the market, and then at a later date, repurchase those shares from the market and return them to that financial institution. So brokerages like M1 Finance and these other free investing platforms loan out your shares to short sellers and earn margin interest in the process. Now, don't be too worried about this again, because through that SIPC insurance, you are insured up to $500,000 for the securities held within your account. So if your brokerage lent out your shares and then they lost your shares, you're insured up to $500,000 for those securities held within your account. And on the M1 Finance website, for example, they publicly stated that they lend out less than 5% of securities, meaning that 95% of them stay in the brokerage account. Only a small percentage are being lent out to short sellers. Number 5, the fifth way these brokerages are able to make money is through something called a portfolio line of credit. Now, most of us are familiar with a home equity line of credit, and it's honestly quite similar. A home equity line of credit is a way for you to get a low interest loan for whatever you need. Maybe it's medical bills, maybe you want to go buy a car, whatever it is. It allows you to get a low interest loan which lets you use your house as collateral. So if you don't pay back that debt, they have a lien on your property and they have a right to ownership of your property, or if it's liquidated, they're going to get money back in that liquidation process. The exact same thing is possible with some of these brokerages, one example being M1 Borrow. So you're allowed to borrow money against your securities at a very low interest rate because you have collateral in place. So if you had an unsecured loan, that could be 15 to 20% interest, but a secured loan might be anywhere from 4 to 6% interest. Obviously, those are just guesstimations, those are not real figures, but it's usually somewhere around there. So it's an appealing way for people to get access to a line of credit without a high interest rate. And of course, if you did in fact default on your obligations, the brokerage has the right to sell your stocks to recoup that loss. Now, number 6, the final way these companies are making money is honestly quite controversial, so I wanted to save it for last, and it's also the most complicated, but I'm going to try to explain it in the simplest way possible. And that is that these companies are making money by directing order flow. Now, there's a number of different components at play here, and we're going to add on to these one at a time as we go, starting off with your brokerage account. So your brokerage account is essentially where your stocks live. In order to have stocks and invest in the stock market, you have to do this through a brokerage account. Now, when you buy and sell shares, this happens on an exchange. The two most common ones people talk about are the New York Stock Exchange and the NASDAQ. And essentially, that is an exchange that connects buyers with sellers, and it allows you to transact stocks and do so in a very short period of time. And the measurement of how easily assets change hands is known as liquidity. So stocks, publicly traded stocks, have high liquidity because they can be easily converted into cash. Meanwhile, something like real estate has lower liquidity because it's not on a public exchange, and it's a lot more difficult to turn a piece of real estate into cash. So let's start with those components and begin explaining what we have going on here. So when you log into your brokerage account and you go to sell a stock or buy a stock, it is going to go through an exchange, most likely the New York Stock Exchange or the NASDAQ. And on these exchanges, you have public quotations of all of these different assets. Now, within that, you have two different things here. You have the bid price and then you have the ask price. And the bid price is essentially what people are willing to pay for the stock, and the ask price is what people are looking to sell it for. And there's always a difference between these two numbers known as the spread. So let me give you guys a quick example here to make sense of what I just threw at you, all right? Let's say you have Scribner stock if my company traded on a public exchange and you had a bid price of $10.50 and an ask price of $10.55. That means that people are trying to buy my stock for $10.50 per share, people are trying to sell my stock for $10.55, and there is a spread of 5 cents. So if that order was filled at that exact instant, it would be filled somewhere between $10.50 per share and $10.55. Now, there's another component here that we have to talk about, and that is something called a market maker. And the market maker is essentially the middleman in this transaction. And why we have a market maker is so that we can have that thing called liquidity, which is the ability to buy and sell our stocks at a moment's notice. So as you can imagine, people who are buying and selling stocks are doing so at very different times. Maybe one day you're seeing a lot of people trying to buy this particular stock or sell another one, and you're not always going to have a perfect buyer and a perfect seller lined up at the right time. So let's take Scribner stock again, for example. Let's say somebody's trying to sell 1,000 shares, but then someone's only trying to buy 200 shares at the exact same time. Well, that order wouldn't be filled because there's an additional 800 shares that have to be sold. Essentially, what the market maker is doing is filling that order regardless of whether or not they have somebody on the other end to buy it at that exact moment. So if you were looking to sell 1,000 shares of Scribner stock, they're going to fill that order immediately, and then they're going to sell those shares whenever orders come up. And in doing so, they're looking to make a profit on that spread. So just to use an example here, let's say they bought shares of Scribner stock, 1,000 shares at $10.50 per share, and then they sold these off in 5 different lots of 200 for $10.55 per share. They're making 5 cents per share across 1,000 shares. And so a lot of people think this is a huge scam, having these market makers, but the truth is they have a very important role in the way that stocks and publicly traded assets trade on exchanges by offering you that immediate liquidity. If we didn't have the market maker, we would not have the liquidity that we have today. And if you were looking to buy and sell shares, there would be no guarantee that you have a buyer or a seller on the other end at that exact instant. So the market maker provides a very useful service of providing us with liquidity, and in the process, they make money on that spread. So circling back to the brokerage accounts, you have something called order flow, or essentially where they're actually sending these orders to be placed. So M1 Finance, Robinhood, Webull, they're all allowed to prioritize whoever they're sending these orders to, and they earn money in the process by directing order flow to certain market makers. So on their website, M1 Finance disclosed how much they are making, and they said that they direct orders to electronic market makers that earn them roughly 0.02 of a cent per share transacted. And when you multiply that across thousands or tens of thousands or millions of shares trading hands each day, that could be a significant amount of money and a good revenue stream for these brokerage accounts. So anyways, guys, that is going to wrap up this video. That is how these free investing apps and free trading apps are making money. They all carry the same SIPC insurance as the traditional brokerages do, and they are just as safe as these other brokerages that we are all used to. You always want to make sure that they have SIPC insurance, but the 3 names mentioned in this video, I have vetted all of them, done massive amounts of research on them, and I have an immense amount of trust built for all of these platforms. So they are not a scam, they're not stealing or selling your information, they simply saw inefficiencies with the old way of doing things, and they figured out new and creative ways to make money. Now, circling back to one more point I want to make here, let's talk about the free stocks, because these companies are often giving out free stocks or free investing credits for their referral programs. And as we mentioned earlier, Webull, of course, is offering 2 free stocks if you click the top link in the description below. And that is because of something called venture capital. So because these companies are rapidly gaining market share, there are people who want to invest in these companies on the ground floor or during early financing rounds because they're looking to make money. And so these companies are backed with millions, hundreds of millions of dollars of venture capital, and they're spending that money on ads and customer acquisition. So just to give you an example of this, Acorns finished another round of financing in January, which raised another $105 million, giving them a valuation of $860 million. And one of the most well-known Acorns investors from earlier on is none other than Ashton Kutcher from That 70s Show. I just think that's funny. I've seen him on the ads before, but Ashton Kutcher is a venture capitalist who invested in Acorns. So these companies have hundreds of millions of dollars to play with in terms of advertising as well as affiliate relationships, and that is why they are able to pay people like me affiliate commissions for referrals and give the users free stocks, free investing credits, whatever it is that they're offering. So essentially, you get people like me. And I write reviews of different brokerage accounts, I do videos of different brokerage accounts, and then I have affiliate links which are in the description below. And then when people click on those links and sign up, I earn commissions in the process. And just from these brokerage accounts alone, we're talking probably $10,000 to $15,000 per month in total is what I'm earning just from affiliate commissions by reviewing these apps and making money in the process through these affiliate relationships. So of that hundreds of millions of dollars of venture capital, a small amount is trickling back to me because of my affiliate marketing efforts. So that being said, guys, if you do want to sign up for Webull and get those 2 completely free stocks and see how this whole process works, that is the top link in the description below. But if you are like the 1% of people who see past the smoke and mirrors and you're curious about my business model of affiliate marketing, which allows me to earn $20,000 to $30,000 per month across all of my different affiliates, I have a completely free 2-hour training I'm going to point you guys towards down in the description below that goes into a lot more detail about my business model and how I make money doing exactly this, which is making referrals to different online platforms. But thank you guys so much for watching this video. It's been a question I've been getting for a very long time. I hope I did my best to answer it in a very simple way. If I did, make sure you hit that like button and subscribe to be notified of any future uploads. Thank you so much for watching, and I will see you in the next video.